Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Hafiza binti Hussein and my matrix number is 083940. Okay. Our content in Conceptual Framework for Financial Reporting is first, objective of financial reporting, second, qualitative characteristics of useful information, third, components of financial statement, fourth, element of financial statement, and last, accounting assumptions in preparing financial reporting. There are four general objectives of financial reporting. First, provide information to users. Provide financial information about the reporting entity that is useful in making decisions relating to providing resources to the entity. Second, assess financial performance and position. The framework ensures that financial reports offer relevant and reliable information to investors and other stakeholders for decision-making purpose. Third, facilitate economics decision-making. Changes in reporting entities' economics, resources, and claims results from that entity's financial performance and from other events or transactions such as issuing debt or equity instruments. And fourth, monitor management stewardship. Recognized as a key aspect of financial reporting, ensuring accountability for the resources entrusted to an entity.
We will move on to component of financial statement. There are 5 components of financial statement. The first is statement of profit or loss and other comprehensive income. The second, statement of changes in equity. The third, statement of financial position. The fourth, statement of cash flow. And lastly, notes to the account. The first financial statement is statement of profit or loss and other comprehensive income. It is also known as income statement. This statement describes a company revenue and expenses along with the resulting net income or loss over a period of time due to earning activities. We can see from the example given, when revenue minus expenses, we will get the net income. Revenue and expenses differ from companies to companies. For example, we have rent expenses, salary expenses, and we also have insurance. The second is statement of changes in equity. It is also known as statement of owner's equity. This statement explains changes in equity from net income or loss and from any owner investment and withdrawal over a period of time. This statement will involve the capital, the investment, the net income, and the withdrawal made by owners. The third is statement of financial position. It is also known as balance sheet. It describes a company financial position, which is the types and amount of assets, liability, and equity at a point in time. From the example given, we can see that the type of asset is cash, supplies, and equipment. Other examples also include land. And another example for liability is loan from bank. The total asset must also equal the total liability and equity. The fourth is statement of cash flow. This statement identifies cash inflow and cash outflow over a period of time. From the example given, we can see the cash flow from operating activities such as the cash received, inflow, and cash paid for supply, rent, and to employee, which is salary, outflow. And lastly, we have notes to the account. Notes are required by International Accounting Standard Number 1. There are 3 functions for notes. The first is present information and policy, which is the basis of financial statement. Second, disclose information required by International Financial Reporting Standard that is not presented in financial statement. And the third is provide information not available in financial statement that is relevant to the statement. And notes must be presented in systematic order.
Assalamualaikum. My name is Nurul Syafiqah binti Azlan. My matric number is 084067. Now I want to present about qualitative characteristics of useful information. Qualitative characteristics are the attributes that make financial information useful to users. There are 4 qualitative characteristics that I will elaborate. First, relevance, understandability, comparability, and reliability. First, I will elaborate about relevance. Relevant is the one of qualitative characteristics that elaborate about the information must be relevant to the needs of the users, which is the case when the information influences their economic decisions. This may involve reporting particular relevant information, or information whose omission or misstatement could influence the economic decision of users. Relevant financial information can make a difference in the decision made by users. Financial information is capable of making a difference in decision if it has predictive value, complementary value, or both. So, in summary, Relevance means that information has predictive or confirmatory value. This can help users to predict future outcomes, for example, future profits. When you get revenue 100,000 ringgit in previous year, so in the future you can target to get 150,000 ringgit for next year. Secondly, understandability. Understandability is the information must be readily understandable to users of the financial statement. This means that information must be clearly presented with additional information supplied in the supporting footnotes as needs to assist in clarification. Classifying, characterizing, and presenting information clearly and concisely make it understandable. For example, in audit report was provide notes to the account for users to check the detailed reference to the financial statement. Thirdly, comparability. Comparability means the information must be comparable to the financial information presented for the other accounting period so that users can identify trends in the performance and financial position of the reporting entity. Comparability is the qualitative characteristics that enable users to identify and understand similarities in and difference among items. A comparison requires at least two items. Users must be able to compare financial information across entity and over different periods. This requires consistent application of accounting policy and proper disclosures and any change. Just as users must use the same report format as previous year for the next year, so the users can make comparable easily because they know the flow of the same format. Last but not least, reliable. Reliable is about information should have minimal errors and omissions. While perfection may not always be achievable, the process used to produce the information must be robust and capable of reducing errors. Information is reliable when different knowledge and independent parties can reach a consensus that the representation is faithful. Verifiability ensures that users can trust the data provided in the financial statement. So the report of the financial statement should follow the standard of AAPG, which is Audit as Assurance Practice Twice under MIA, just as auditor should make bank confirmation with their bank clients. That's all from me. Thank you.
Hi, my name is Nurja Binti Muhammad Zaini, matrix number 084031. I'm about to explain the elements of a financial statement. There are two types, which are financial position and financial performance. First thing first is the financial position. Here we have asset, liability, and equity. Asset means result of past event or resources that controlled by the entity. For example, cash, receivable, account receivable, building, plant, and machinery. The second one is liability. Liability is a present obligation of the entity that arising from past event, such as trade payable, note payables, and bank loans. Next is the equity, which is a residual interest in the asset of an entity after deducting the liabilities like ordinary shares, retained earnings, and revaluation. And other elements that related to financial performance are income and expenses. Income is when the economic benefits increase during the accounting period in the form of inflows or enhancement of asset, or decreases of liability that will result in increases in equity. While for expenses is when there are decreases in economic benefits during the accounting period in the form of outflows or depletion of asset, incurrences liability that will result in decreases in equity. Next is about recognition and derecognition of elements of financial statement. Recognition means inclusion of an element of financial statement when it links the element in the statement of financial position or statement of financial performance, as follow as asset, liability, income, and expense. So in the statement financial position, at the beginning and at the end of the report, there are asset minus liability equal to equity. And we also have income minus expenses that recognized in the statement of financial performance, and contribution and distribution to holders of equity. These two items are recognized changes during the period. So for derecognition is a removal of all or part of recognized asset or liability from the statement of financial position that basically not an asset or liability to the company anymore. So for asset, it is not your asset when you don't have control of it anymore or no future economic benefits to expected. For liability, it's not your liability anymore when you no longer have an obligation or have not present. Next, we talk about the measurement. While recognition means when or whether to recognize, measurement means in what amount to recognize. More specifically, measurement is a selection method for measuring elements of financial statement. And the framework discusses two basic ways to measure things in the financial statement. They are historical cost, That basically historical cost is a transaction price, which is the original spend on the asset and the original amount. And the second one is current value, which measures the element that includes current cost, realizable value, and present value. Current cost is the replacement cost or current market price, while realizable value is the expected value from the selling asset. And the last one is present value, is the discounted future cash flow. That's all for me. I'll pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Situn Khadijah binti Wan Hasan, number metric 08391. So for my part, I will explain about accounting assumption in preparing financial reporting. So, what is accounting assumption? To put it simply, an accounting assumption is a set of rules that helps to ensure financial report of the business are prepared in line with applicable accounting standard. It lays a strong foundation for consistency, reliability, comparability, and valuable financial information that the readers of financial statement can use to evaluate the genuineness of company's financials and confirms its financial well-being at the same time. There are quite a lot of accounting assumptions that can be covered today, but I will only explain the basic accounting assumptions that allow companies to function in a proper manner. The first assumption is going concern assumption. This assumption is based on the principle that while making the financial statement of an entity, we will assume that the company will never go bankrupt and it shall be able to perform its business operation for a more extended period, at least 12 months minimum. This assumption is important because it allows for proper accounting of fixed asset and depreciation. Because we generally use the historical cost method to value assets, we have to assume that the business is unlikely to be shut down in the future. But if the company is bankrupt, company asset must be valued at market price for liquidation and paying off debts to creditors, and financial reporting in this situation follows the liquidation basis of accounting. Next is reliability assumption. This assumption makes it mandatory for the companies to record only such accounting transaction that can be easily proven. In other words, financial transaction that can be verified through invoices, billing statement, receipts, and bank statement must only be recorded in the financial statement. The next assumption is accrual basis of accounting. Under this assumption, accounting transactions are recorded in the books of accounts when they occur, not when cash is exchanged. This ensures that financial reports reflect the true economic events of the business over a given period. But keep it in mind that there are certain limitations to this assumption, such as this assumption is not suitable for small organizations who would prefer the cash system because it can be a time-consuming and confusing process. Next is consistency assumption. This assumption makes it critical for businesses to use a consistent method of accounting for all the accounting periods. A consistent accounting method will allow for easy comparison of the company financial statement across different financial periods. When accounting treatments and methodologies remain consistent over a number of years, management can properly draw conclusions about the performance of a company. It is a key aspect of management planning and decision-making process. However, change is not entirely prohibited. Sometimes it is necessary to make changes under the following condition. If it is statutory requirement and the entity will have to change its accounting policy to abide by the law, other times a change in policy will allow them to represent their accounts more fairly and appropriately. The next assumption is business entity assumption. This assumption separates the owner of company from the company itself. It means that the business entity assumption separates the company's financial records from the owner's personal financial records. It's to ensure that the financial reports reflect the financial performance and position of the business itself, not its owner or stakeholder. And the last assumption is time period assumption. This assumption indicates that an entity accounting practices and process must be recorded and maintained over a specific time period like quarterly or yearly. The company must ensure that these periods remain consistent for each year. This assumption helps create a structure for financial reporting, ensuring that information is available at regular intervals to inform stakeholders. So, that's all from me. I hope this presentation can help anyone who see this video. Assalamualaikum warahmatullahi wabarakatuh.